Welcome to The Explainer. Today, we're putting a real estate giant under the microscope, VICI Properties. Now, you might not know the name, but you almost certainly know their properties. They own some of the most iconic casinos and entertainment venues in the world. So, is this high-profile company a hidden gem for investors? Let's find out. Our goal today is to cut right through the noise, dig into the financials, and answer one really important question. Based on the hard data, what is VCI stock truly worth? Okay, so first things first. Before we can start crunching any numbers, we've got to know who we're dealing with. So who exactly is VCI Properties? Well, VC is a huge player in the real estate sector. They're a specific kind of company called a REIT, which stands for Real Estate Investment Trust. Just think of it like a mutual fund, but for property. They own a whole portfolio of buildings that generate income. And VC's specialty? Owning these massive, iconic casinos, hotels, and entertainment destinations. The company is steered by a team of really experienced executives. The person at the helm is CEO Edward Pitoniak, and he's the one leading the grand strategy for this massive portfolio. Now, take a look at who owns the company. This is pretty telling. We're not talking about small-time investors here. The biggest names in finance, we're talking Vanguard, BlackRock, State Street. They all own significant chunks of VC. This is what people call smart money, and when they invest this heavily, it suggests a pretty high level of confidence in the company's future. All right, now that we know who VICI is, let's take its financial pulse. We're going to start with some key performance indicators that give us a quick snapshot of the company's overall health. Wow, okay, the first number that just jumps right off the page is this one, a gross margin of over 99%. That is exceptionally high. It really showcases incredible efficiency and profitability. Basically, for every dollar of revenue they bring in, almost all of it is gross profit. This slide gives us a broader look at VICI's valuation. Its market cap is over $30 billion, making it a true heavyweight. The PE ratios kind of show what investors are willing to pay for each dollar of the company's earnings. But the number that I find most interesting here is probably the PEG ratio. It's so useful because it compares that PE ratio to the company's expected growth. And a PEG ratio under 1, like VICI's 0.89, can sometimes be a big hint that the stock might be undervalued. Okay, time to get into the nitty-gritty, the financial statements. This is where we get to see the hard numbers behind the company's performance. So, looking at the annual income statement, the key takeaway is a clear and consistent upward trend. Total revenue has climbed like crazy from around $1.5 billion just a few years back to nearly $3.8 billion now. And that growth trickles right on down to gross profit and net income. It just paints a picture of a business that is expanding and doing it effectively. And the balance sheet? It tells a very similar story of aggressive growth. Total assets have just ballooned from about $17 billion to over $44 billion. Now, of course, that kind of expansion is funded by a mix of equity and, yeah, a big increase in total debt. But that's pretty typical for a real estate company that's scaling up its portfolio this quickly. And finally, we have the cash flow statement. You know, a lot of investors think this is the most important of the three. Why? Well, because it tracks the actual cash moving in and out of the business, and that's a lot harder to fudge than reported earnings. And for VICI, the picture looks very, very healthy. Their operating cash flow is strong and it's growing, which means their core business is basically a cash-generating machine. So we have all this powerful financial data. How do we put it all together to figure out what the company is actually worth? For that, we're going to use a standard and very powerful tool from the world of finance. We're using what's called a discounted cash flow model, or DCF for short. The easiest way to think about it is this. It's like calculating a sticker price for the entire company. You do that by projecting all the money it's expected to make in the future, and then you adjust that value for the fact that money today is worth more than money tomorrow. Of course, any financial model is only as good as its assumptions. For our analysis, we've used some pretty standard inputs. For example, the beta of 0.714 suggests VICI's stock is actually less volatile than the market as a whole. And the WACC, which is the weighted average cost of capital of 6.5%, that's the rate we're using to discount all those future cash flows back to what they're worth today. So by tweaking those assumptions just a little bit, this analysis gives us a logical range of potential values. In a more conservative bear case, the model points to a value of about $65 per share. And in a more optimistic bull case, that value climbs up to $77 a share. But the base case, right? The one that represents our most likely scenario based on all the financial data and standard growth projections, it calculates VICI's intrinsic value at a very specific number, $75 per share. So what happens when we take our calculated, data-driven value and compare it to the price the stock is actually trading for on the open market? This is the moment of truth. And here it is. This is the bottom line. Our model suggests an intrinsic value of $75 per share, but the stock has recently been trading for around $29 per share. That is a huge difference. So the conclusion based on this analysis is pretty clear. According to this specific discounted cash flow model and its underlying assumptions, the stock appears to be significantly undervalued by the market at its current price. This purely data-driven analysis seems to point towards a major opportunity for investors. But it also leaves us with a final and absolutely critical question. What external factors or unforeseen risks, the things that don't show up neatly on a balance sheet, could these financial models potentially be missing?